Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. Signs of stabilization and potential growth are sprouting in the global real estate market. As economic conditions remain resilient, certain areas within the sector look more promising than others. Joining the show today to discuss the sectors in which he is seeing demand and strategies he implements to enhance portfolio resilience is Fidelity Global Real Estate Fund Portfolio Manager Steve Bowler. Steve highlights that recent interest rate reductions have positively impacted real estate performance, especially when compared to broader global equity markets. He notes a significant shift towards income-oriented and defensive real estate sectors, like data centers and industrial properties, due to consistent demand and limited new supply. Going in depth on data centers, he explains the land grab effect they're experiencing due to the explosive growth of AI and cloud computing. He also discusses the evolving office market, explaining what the trend of companies reducing their office space due to remote work could mean for the future of the sector, particularly the potential of repurposing office buildings for other uses. Steve also touches on Hong Kong's market, the healthcare real estate sector, and the complex relationship between real estate and bonds. Today's podcast was recorded on August 26th, 2024.
I wonder if we can begin with the obvious question, which is the real estate question. It's with the interest rate as it relates to the real estate story. We've got the pivot, everyone seems to believe. What does it mean for real estate broadly and for you?
Yeah, although I tell people over long periods of time, there actually is very little correlation of the return of global real estate and interest rates. But unfortunately, the last couple of years, the absolute return, whether negative or positive, has been driven by interest rates. So the last 2 months with the reduction in global interest rates, this has been an impetus for change, that is for positive performance and relative outperformance, especially versus broader global equity markets.
Yeah, it's amazing. I mean, the last couple of months, well, just take us through the performance of the last couple of months. I mean, it's been quite a year where we saw the Mag 7 take off through the early part of the year. I mean, it's a continuity there. But when did real estate sort of catch the flame?
Yeah, it started about 2 or 3 months ago when we did have the correction in the growthier part of the equity markets, whether the Mag 7 or any in the US or the NASDAQ related stocks. Then there was more interest in what I'll say income oriented or defensive stocks, such as real estate.
Yeah, so the REITs outperformance was there ultimately. Any other factors that pile into this? It's real estate so connected to the interest rate story, but what else?
I actually think that the stock market, which does an excellent job of looking forward, is seeing that there's a limited amount of new supply in many sectors. And where there has been some supply, for example, Sunbelt apartments in the US, logistics facilities in Europe or North America, or even some self-storage facilities in Australia, the US. And they're looking forward and seeing, that's starting to go towards zero in the next 12 to 18 months. So that bodes well for the fundamentals, as long as we can have consistent demand.
Okay, so consistent demand. That's really interesting because it comes into sort of, I want to ask about office and lots of other places. We'll dig into all of those. I wonder if I can just first ask you to take us through the fundamentals of the fund, the universe that it looks at, ultimately how you invest. Just remind us of some of the facts of the fund itself.
Yeah, I kind of look at 3 pillars, if you will: fundamentals, access to capital, and that cost of capital, and valuation. So let's take each pillar individually. First, the fundamentals. The fundamental outlook for the majority of sectors is actually quite good, although there's a lot of publicity of what's happening in the office market. But that's actually a very small percentage of the benchmark or the listed world, although in the real world, office is still a very large component. So I actually think that the fundamental outlook is quite strong. Now, as we talked about earlier, with the reduction of interest rates, the capital side, and real estate is a capital intensive industry, is starting to get very, very good. That is, the cost of capital is going down, whether it's the interest cost that the REITs pay on their debt, or that is the ability for them to accretively issue new capital to acquire stuff. And lastly, the valuation. Now, the valuation with the performance recently is not as discounted as it was, but I would argue that it's still slightly discounted to its long term historical um, tools or measures, if you will, whether on a multiple basis or, secondly, on a discount to its net asset value, that is the value of the real estate itself.
Right. That's fascinating. So interesting. Real estate is a fascinating topic. Um, Take us through how you parcel out or we think differently about AI data center demand um, involving the Mag 7, which are flush with cash flow, we know. How does that sort of just come off the overall story for real estate? Where is that demand coming from?
Yeah, now I should say this is one sector that is in data centers where we're actually seeing a lot of new supply. So this is not going down in the next 12, 24 months. But at the same time, the demand, which has just exploded, because I tell people AI, it actually happens in a data center or it flows through a data center. So all those chips have to be stored, or I should say, cooled somewhere, and that is in a data center. And we're seeing tremendous rental rate growth, especially in the hyperscale arena. That is where AI happens. But at the same time, even basic cloud service, whether it's for personal or professional use, continues to see, I would say, increased demand, even following the pandemic bubble, not bubble, I should say, boost that it did have.
Yep. Yeah. So that's fascinating. Yeah. And it's, I mean, it also just, those big companies haven't really had to, I mean, maybe it's too simple to say that they haven't had to worry about the interest rate story, but they kind of haven't needed to worry about the interest rate story in terms of cost of capital. It's not a big deal for them in the way it is for others.
That you're exactly right. That is one sector where that capital cost has a matter because right now there is, I'll call it a land grab going on for data center space. And data center space is defined more than anything today by access to power or electricity, and especially green power. So who has that? Who can get that? Who can get it permitted? And who can deliver it the quickest is what's really driving, I would say, the outsized data center demand for both AI and for cloud computing.
Does the data center demand go on both sides of the border? I'm just wondering, because as you say, proximity to, power sources, would the US be comfortable having data centers in Canada? Do you look at that? Does Canada happy to have their own data centers in the US and bring it across? Like, is there some fluidity there? Is it a North American story or is it more specific?
I would say it's actually a global story, and that's kind of driven by where you have access to power. But at the same time, for example, you're in Europe, you have data secrecy laws, if you will. So that does drive some why they most have to locate data centers in the countries where they're going to be used. Otherwise, we do see kind of chasing a little bit where you can get the access to the cheapest power or the greenest power. So there is a little bit of border crossing, if you will, but I wouldn't say that's the big driver of the demand right now.
It's where you can plug in.
Where you can plug
You
in.
got to plug it in.
Oh,
And we'll take on some other sectors in a minute, but I'm curious how much the data center story fits into your positioning. Is that the biggest positioning around that?
we do have an overweight versus the benchmark, and interesting enough, in some of our logistics facilities, they are becoming semi data center plays too.
Okay.
Because whether you have an existing logistics facility that has access to power and maybe the lease is coming up, or you have a development pipeline that has access to power, all of a sudden it's called in the real estate world HBU, higher and better use. That land could be used today at a higher, better use as a data center than as a logistics facility. So we are seeing, for example, approximately plus or minus 20% of development pipelines for logistics facilities being converted to actually data centers.
When you say land grab, just flesh that out for us a little bit. Like, what are we talking about?
Well, all the big AI functions, if you will, they all need a tremendous amount of chips, and those chips need to be stored or used somewhere or cooled somewhere. So they need to go in the data center. So all those chips and well-known NVIDIA is a large AI play. They have to go in data centers. So right now there's a huge land grab going on to actually be able to do all those functions, AI functions, and I think right now there's the land grab to figure it out in a couple of years, and we're very cognizant about this too, and spend a lot of time analyzing it. Will there be then, for example, a slight day of reckoning where maybe they took on too much space or they don't need as much space in the data center space, or they could, I may need it more here in Frankfurt, Germany than I do in Chicago, Illinois.
Got it. So interesting. But it is a land grab to put a large warehouse of sorts on it, or a facility on it ultimately.
Well, if anything, a data center is a large cooling facility more than anything.
Right, right. What do they use to cool it? I was curious.
Well, there's a variety of different methods, but most of those methods you need power, electricity. So hence the large amount of power generation, which is when you rent a data center, you're actually renting it in megawatts, not by square feet or square meters.
That's fascinating. So whatever version of air conditioning you're using, they need a lot of it ultimately.
Sure.
Let's go into some other sectors. So we've spent time on that one. That's always a hot topic. Where else? We'll talk about office for sure. But where else? Like industrials is the name of the game, which fits into data centers, or is there more?
Well, there is, and the fund does have an overweight to industrial. If anything, kind of the post-pandemic boom of industrial had a slight cool down around the world. That is, there was quite a bit of new supply, and then with the slight cooling of the economy, or there were some users that took so much space in the pandemic, they needed to actually absorb that or use that. And that's hence why one reason why we like industrial on a forward-looking 12, 24-month basis, whereby that supply and demand balance will become more imbalanced. And then we should start to see rental rates start to increase after flatlining for the last 6 to 12 months. Just a general statement globally.
Yeah. Okay. That's fascinating. And going into, for instance, there's a version of a trough that's gone through in certain sectors of it. Is access to capital something that is actually seeing borrowing happening to build up the sort of CapEx story ultimately, but been in a real estate sense? Like are loans happening and building, getting ready to go?
Yeah, I would say when I say the access to capital, yes, it is. It also includes the debt side, but it's more the equity side,
Oh,
whereby the REIT structure and about two-thirds of all listed property companies are in a REIT structure. And a REIT structure, one of the common tenets around the world is you have to distribute the majority of your cash flow out in the form of dividends. So hence they need to constantly raise capital if they're going to buy new buildings and or develop new buildings. And more recently, we've actually seen quite a few equity raises whereby they can accretively, that is, enhancement to their earnings or to their net asset value, they can buy new buildings because they have a cost of capital advantage once again. And we see that, for example, in Australia, a childcare property owner recently raised equity. We see it in Europe where self-storage ones are raising equity. And this is then provides external growth to these companies, which has been somewhat dormant the last few years because they haven't had that cost of capital advantage.
that's fascinating. What else in terms of types of investments that you like? So you mentioned, that's a nuanced thing, Australia, health, childcare. What else? Are there some global themes or just even country themes that are seeing a buildup?
Yeah, I don't actually have too many country themes, if you will. What we're seeing with the interest rates and the kind of the fundamentals are across most of the developed countries that I invest in, absent Hong Kong. I am underweight Hong Kong. The geopolitical risk that we're seeing is impacting demand, whether it's for office, whether it's for retail, whether it's for residential for sale. Additionally, at the same time, they do have a little bit of too much supply of retail and office. So hence, from just a fundamental outlook, we don't like Hong Kong. One sector, though, where we see around the world, but it kind of varies by what type, is in the healthcare real estate world. We continue to be overweight, especially in North America, what I'll call the assisted living. That is, when someone typically it's someone who's 85 years old or plus, and they can unfortunately no longer live in their home and or the childcare providers, which are primarily their children, may not be able to actually do it anymore. So we're seeing tremendous amount of demand come back after what I'll call the COVID period, when people weren't moving grandma or grandpa into a facility. And at the same time, due to unfortunately mortality, that these facilities did lose some occupancy. But right now, we're seeing tremendous amount of occupancy pickup and actually rate pickup, where it's one of my favorite sectors actually globally.
Okay, globally. And you mentioned this off the top, but you invest for a global theme, for instance, mostly in developed markets, so-called developed markets.
Yeah, this fund primarily, if you just want to look at the benchmark, is the developed world. Now, is there some minor exposure to emerging markets? Yes, some of the Hong Kong listed ones do invest in mainland China. Some of the European ones invest in Central and Eastern Europe, but it is quite de minimis.
We've got a week, Steve, of just all kinds of heavyweights in the retail space, lots of apparel, all the kinds of stores you'd see in malls, for instance, releasing their earnings. I'm curious about the mall space, the consumer, maybe what you do or don't look for in these earnings, but more the real estate side of it. What is the story in terms of demand, in terms of oversupply? I think we've worked through some of the over-malled areas of the United States. What's the status quo now?
Yeah, I mean, generally speaking, around the world, we have worked through the oversupply of bricks and mortar retail real estate, which was impacted tremendously by e-commerce starting about 20 years ago. And if there's one sector globally where we have not seen much new supply, it's retail. So with that limited amount of new supply, and at the same time, the tenants themselves, the retailers, have kind of perfected their omni-channel strategy, whereby the store is actually the hub, if you will, or where they actually make the most money. So we see retailers reinvesting in the store. Now, we obviously are monitoring, same store sales around the world, and yes, there is a slight slowdown, especially in a lower end consumer. But what I look more specifically at all these retailers is, what are they doing with their unit growth? And we continue to see many of them um, having similar, if not want to increase their unit growth because they're not able to actually get enough boxes open. There's such a limited supply, especially of high quality retail real estate. So when boxes do become open, we do see the retailers kind of jumping at them. And at the same time, they're willing, and the landlords themselves are pushing higher rental rates, which I love, of course.
Yes, of course. Absolutely. First, just want to ask if there's a comparison to be made, the over mauled story sort of 15, 20 years ago to the over officed, perhaps, story that is being worked through right now, and then get a little bit of a follow up on that. Are there comparisons there?
There are some similarities, if you will. The one is the mall sector, especially in the US here, has taken about 20, 25 years to kind of work through the excess supply. And we're still doing it. You're still demalling. And what I said earlier, higher and better use, for example, of a parcel of land or a building. That, in my opinion, is what we're seeing in the early stages of the office sector.
Interesting. What would be higher and better use for an office, for instance, in, I don't know, maybe a less desirable, slightly more in the suburbs type thing? Could that be a data center?
That could be, I mean, usually in suburban one, it becomes just what is the land itself worth? It's
Okay.
easier than to get rid of the building itself, whether it's a data center, logistics facility, residential, if you will. Those are typical. More urban areas, it's a little more difficult. And the primary conversion that we've seen, albeit it's a very small amount, it's actually getting more headlines and actually occurring, is the conversion to residential or to retail. I'm sorry, to hotels.
Yes. Okay. Really, really interesting. So with Office, where does it stand? What are some of the themes that, as it's being worked through, are starting to become apparent? I don't know if it's attractive yet, but what are the themes that are being worked through at this point?
Well, we do see a difference between North America and the rest of the world, whereby in North America, the kind of remote work is much more prevalent, if you will, much more accepted, much more being taken advantage of, and for a variety of reasons. One, typically the commutes are longer in North America. Secondly, people have a much larger living space, so they have room for a second office or a place to work. Whereby, if you live in Hong Kong, the average, a flat in Hong Kong is 500 square feet. So there is no excess space to have a second office, if you will. There's cultural reasons. FaceTime, for example, in the Japanese office is very important, and so there's not as much remote work. And what we're seeing, though, in North America is what I call the long-term demand destruction. Now, on average, if a company X, this imaginary company, has had no employment growth or anticipates no employment growth, it's a white collar employer, we're seeing on average when they renew their office lease that they're taking anywhere between 80 and 90% of their previous office space. So that's kind of a 10 to 20% demand destruction. That's going to take a long time to play out. We're still in the early stages of that demand destruction post-pandemic here. Because office leases, on average, depending on the country, 3 years in Japan, 10 years in North America, those lease expirations are the kind of the trigger event for demand destruction or demand reduction, if you will. And that's what's occurring in the office market right now. And I'm kind of still very long-term bearish on, especially North American office. I do own office REITs outside of North America.
Okay, very interesting. It's sort of long-term bearish. Okay, really helpful. Just get this squared away. How defensive is the real estate sector, Steve, and what impact did lower rates have on REITs?
Yeah, I think you've started to see some of that impact the last 2 months, whereby the performance of global REITs it's been one of the best performing equity sectors. And I like to tell the example of going way back in time, and I'm dating myself, the global financial crisis. Um, no, I'm sorry. I want to go farther back. I want to go to the
I was
tech.
going to say, that's not that, yeah.
No,
Okay.
I know. It's Monday. I apologize. I'm going back to the telecom bubble of 1999. So I'm going to date myself there,
Okay.
whereby no one cared about dull, boring REITs in the tech telecom bubble. And every day, these companies that really didn't have very good businesses kept going up. Post that bubble burst, the best performing equity sector was the REITs and the real estate. Now, by no means am I saying that that's going to occur, but we did see a little bit of that July. And by no means do I say that the companies of the growthier part or the Mag 7 they're not pets.com. These are real companies with real growth and real cash flows. It's just something to note that when people ignore defensive or income oriented or real hard assets for an extended period of time, that the diversification benefits can once again kick in. And they have started to do that this year. So that's really my main point here. Not to say that there could be a redo of the tech telecom in the post world, but post period there, but rather it's just interesting if the diversification benefits when they do kick in.
Okay, so that makes me just want to add on there. Where does this fund fit in a portfolio for those that perhaps have exposure to whatever? Where does this fit?
Yeah, I mean, most studies have kind of pointed out that it increases return or reduces risk on a diversified portfolio when you have anywhere between 10 and 20% in, for example, in REITs. There's many studies that have proven that. That does what it says it's going to do.
How does real estate correlate with bonds or other defensive sectors if they were to think about diversifying in a different way with defense?
Yeah, and that gets my initial comment. Over long periods of time, the correlation is actually closer to zero, which surprises people. And then you get what I always call this tug of war that goes on. On one side is the capital side of the business, and the other side is the fundamental side. And there's this tug of war that goes on, and hence why you do see over long periods of time very little correlation. Although over shorter periods of time, and that could be a day, a week, a month, or even a year, we can see much higher correlation. And we've
With
kind
bonds, you're saying, with bonds. Yeah.
With bonds, exactly. I apologize. The performance of global REITs with global bonds has been much higher the last 2 years, and definitely the last 2 months, for better or for worse. It was worse 2 years ago, and now it's been much better more recently. So I do honestly hope, though, it does go back long term back to zero, and because then it can be proven there's an interest rate or capital component, but there's also a fundamental side.
Right. Fascinating. Okay. Thank you. Here's a question. You touched on Hong Kong, but this is, mainland China, and the real estate story there is a pretty different story. Any thoughts on Chinese real estate and the recovery there?
I've been a long-term bear on China, and China primarily in the listed world is the residential developers, where the model is just broken, if you will. The municipalities sell land to the developer, and then they get the money from the client, and they build it, and they've run out of money to actually finish the projects. I do think that the government, if they want to solve it, has to probably throw more money at the problem, and they
Yeah.
seem very reluctant to do that. So
Where is the Chinese stimulus? We just don't see it. We keep thinking maybe we will, but we don't. So,
yeah, I'm not a Chinese expert, and the fund has no exposure to the Chinese residential market, so that's the good.
how will the upcoming planned rate resets, we think cuts, impact the housing sector? So, yeah, let's go into a little bit on the housing. You would look more at sort of multi-family and so on, but take us into that story a little bit as we finish out.
Yeah, just to level set here, the majority of my investments are in for rental housing, and very little exposure, except in more outside of North America and Europe, is for residential for sale. So this fund is primarily looking at the rental markets, if you will, and then the demand for rental housing around the world is quite strong. And for a variety of different reasons, it's limited supply except in the Sunbelt markets. And then you have a regulated element, as you know, in Canada, kind of one half of Canada is a regulated market, the other half is a free market, that is. And we do have exposure, for example, to the free market, or primarily Western Canada, whereby we're seeing tremendous rental rate growth due to a supply demand imbalance. Well, so I took that question and I kind of evaded it because the fund really has very limited exposure for sale housing, especially in North America.
Okay. Just a final thought on how you'd like to sum up for advisors, for investors, of, again, sort of the opportunity here as we close out.
Yeah, I mean, I love to reinforce, and it was kind of, dormant there for a while because the growthier part of the equity markets were doing so well, to once again remind people that a fund like this does have a place in the portfolio, and more recently it shows why, and that's the diversification benefits. It can level set or offset some of the market volatility or the negative returns that the growthier part of the market has experienced, albeit we've just had a minor rebound the last couple of weeks. But this is a fund, or the global REIT sector does what it's supposed to do. It provides income, it provides defense, and it has right now, looking forward, pretty good fundamental outlook too.
Fascinating to speak with you and to get your depth of knowledge and to hear about the fund. Steve Buller, thank you for joining us.
You're welcome.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on Twitter. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.